Hello everyone, this is Riya Singh. I'll be sharing my views on the currency. So if you look at what has happened in the dollar index so far, we have seen quite a volatile session into the dollar index. There has been a one-side bullish run. So why has this happened? Of course, one of the main reason why there was a bullish run in the DXY was the market was anticipating quite a hawkish statement from Fed Chairman Powell. Now, so throughout the week, if you have seen, we had a lot. There was no retraction that was coming unless until in Wednesday when the business activity numbers for the US came down. But before that, if you see, Europe and UK numbers were also released, which were on the downside. So they further boosted the dollar index strength. Now, if you have seen at the start of the this week, we have seen quite a retraction that is coming into the dollar index. This is because the market is digesting the current news, and they have digested the hawkish statement from the Fed. Now, what Powell has said is that much more need to be done. He has replicated his previous statements, but if you see, there was not a quite direction with respect to what the interest rate will be in the coming days. He has said that much will be done, much needed to be done in order to get the inflation under control, under 2% ceiling, but no clear instruction as to how it will be done. Like I said, more tighter policy is something that is needed for the Fed to get the inflation under control. But if you see what the market sentiment is right now, if you look at the expectation of the market and where the rate will be headed, interest rate hike is pushed at the later, towards the end of the month or maybe in the next year. But the market sentiment with respect to how long the interest rate will be at this higher level has pushed to the June, which was supposed to be ended into the month end. The expectations have now been moved till June. So this means that the Fed will continue to hold the rate at the higher level for quite some time. Apart from that, we are seeing quite a decline into the whole Fed balance sheet. If you look from May, there has been almost 0.98 uh, $1 billion that have been removed. So almost $1 trillion have been removed from the liquidity and from the Fed balance sheet. This means that they are quite aggressive with the removing of the liquidity and with the quantitative tightening. And I think this will continue in the coming months as well. From 9 trillion, they have it should be ended around, they should end the month around 7.5 or near that number. So I think for the dollar index, it will continue to support the level of 101 in the longer term. There is not much of a trigger that could push the dollar index down because the major component, which is the pound and the euro, both the economy are suffering going forward. We have seen the euro numbers, we have seen pound sliding from the highs. We have also seen euro sliding from the highs. So going forward, I think this put quite a restrictive path with respect to how much interest rate hike that the ECB and Bank of England can do going forward. So I think 25 bips is something that is expected from their part as well, irrespective of where the economy is headed, because the inflation is running quite high as compared to the US, especially in UK. So, but this does put a hold onto their hand as to what or how much they can do in order to get the inflation under control without hurting the economy too much. So I think dollar index will continue to support 101 levels. Upside should be limited to 105. As far as Indian rupee is concerned, now Indian rupee volatility has declined quite a bit. RBI has been intervening quite a lot. Recently, if you see, the forex reserves have fallen and they have intervened into the market at around 83.10, 83 levels in the forward as well as uh, in the OTC markets to get the rupee under 80 to 60, 80 to 50 range. So RBI is quite prudent in controlling the volatility of the Indian rupee. And I think for this week, at least 80 to 70, 80 to 80, 80 to 60 is somewhat the range that we are seeing into. Or I am seeing into, I think it should respect that range. There's not much of a volatility that you can expect. You can either, for strategy purpose, you can go for a strangle which is 80 to anywhere between wherever you get the premium around 80 to 75 call, 83 call, 80 to 50 put, 82.25 put. Once you get good premium, at least 10, 12 paise, you can engage into those kind of strategies going forward. Or at least in the week, because I'm not expecting too much of a volatility. Now, as far as Japanese yen is concerned, I think one should stay away from it. There is no liquidity, there is no intervention statement that have been coming forward from the Bank of Japan. They are not even discussing this risky volatility. Now, right now, if you look at the USD JPY, it is trading at 146.50. So previous intervention was around at 145 levels, and I think next intervention should happen at around 150 in order to control the slide of Japanese yen against the dollar. But if that doesn't happen, JPY INR could see more pain, even it can test 55 and so forth. So I think one should stay away from GPY INR, because apart from this intervention story, there is also the China and Japan risk tension that is going on, coming, arising from the seafood ban that the China has put on Japan. So they are one of the highest importer of seafood from Japan, and if this escalates, more risk is on the Japanese yen. So I think one should stay away from the Japanese right now. And for the current week, the strategy will be, like I said, in go for a strangle in USD INR, that the call and put strike rates that I have set so far. Apart from that, I think for pound and euro also, there will be quite a risky trade. If you look at the pound, 103.72 is the support, and for euro, it is the 89. There is not much of data that could support any bullish run into the euro and pound so far, and I think it will be more of a sideways momentum. So this week, the strategy uh, numbers is would be to trade more into the strangle in the USD INR of the said strike rates. So that's all for today, and from my part, thank you for listening.